Hi guys, welcome back to T Account. Last bit to wrap up the chapter of the topic of non-current assets, revaluation. Revaluation is, you can say, opposite to depreciation. Non-current assets like land and building, they commonly, frequently increase in value, appreciate. Instead of decreasing, they appreciate. So companies have an option given by International Accounting Standard 16 to revalue and to carry their non-current assets like land and building on revalued amount instead of carrying it on cost plus depreciation, whatever. So this is an option for the companies. Sole trader and partnerships, they don't have this option. Now, if they go for revaluation, they cannot pick and choose. If they wanna carry one property on the revalued amount, they need to do this process for the entire class of properties. So, entire class of that asset need to be revalued. So you cannot pick and choose. You can do it on the rolling basis. If you can't do it all together, but you have to do it for the whole class. How do you present it? Like, let's start from the simple land example for which we don't have any accumulated depreciation or anything. Let's say we have land in our books of $200,000. It stayed there for 10-15 years and now we want to revalue it. Revalued amount would be revalued at say 800,000. Okay. Now what are the accounting entries and how it is presented? For accounting entries, simple. Let's say land increased by how much? Already we want to keep it on 800,000 and we have already got 200,000. So revaluation surplus is 600,000. So we'll say land debit 600,000 and revaluation surplus 600,000. Land increased in value by 600,000 and now we had that in the, you can say, ledger. Land we had 200,000 brought forward and by revaluation surplus we have got 600 more. So now the carried value would be 800,000. That's what we wanted. That is ledger balance. Okay. Now, how is it presented in the profit and loss account and statement of financial position? Profit and loss after profit, after tax, you can say net profit. There is another part recently added, other comprehensive income. This is a part of other comprehensive income and this gain is presented in the other comprehensive income, not in the profit and loss account. Reason being, I'll explain that later, but this is shown in the other comprehensive income and in statement of financial position. It will be displayed in equity. There is accumulated revaluation reserves, an account for these things. Accumulated revaluation reserves. So this is added to that account and presented in equity part of the statement of financial position. But for that will be accumulated over the years. Whatever you have will be added to that account. But for the year, whatever you have, it will be presented in other comprehensive income. For instance, here we have this for the year. So it will be presented in revaluation surplus as other comprehensive income. Hope this is clear. Now this was for land for which we don't have any accumulated depreciation. The logic behind why we are not presenting in the profit and loss account and why other the difference is this is unrealized gain. Unrealized gain. This is just an estimate that okay, your property has increased in value by this, but this is not realized until you dispose it off and you get that money. Once that deal is done, then surely that is confirmed that you have this gain, and then the treatment will be different. But now, until now, this is unrealized gain, just an estimate, and you want to present it in the books as well, in the financial statements. Okay, do it, but that is the way you present it in other comprehensive income, so that the users of financial statements, they know that this is unrealized gain. Other things like foreign currency translation reserves and changes in those things, they also are presented in the other comprehensive income. So this is, let's do a small example for other assets other than land, where you have related depreciation and cost, two accounts. Example on page 148, Kaplan FA, Financial Accounting, okay, at chapter 8, chapter 8, page 148. I have already written the relevant information, but this will not be given like that. They will give you a long story, but that is the cost, buildings cost, accumulated depreciation. Net book value is 200,000 because cost is 300, accumulated depreciation is 100,000 that you already have charged over the years, and carrying value 200,000. Revalue, they want to revalue it at how much? 750. 750. So first you need to see, how much revaluation surplus they are getting. For that you need carrying amount, which is 200,000. First need to be revalued at how much? $750,000. Okay, so if you deduct that carrying value from this, 750 less 200,000, you will get total surplus 550. This is the total gain. But how will you book it? In the land you had only one entry and khalas, done. But here you have related accumulated depreciation as well. If you only take that cost to 750, you will not get carrying value of that 750, because you also have that accumulated depreciation account. So you need to clear that account as well. See, for instance, you have this building account and accumulated depreciation. This was brought forward how much? 300,000. Here you had 100,000. Okay, if you simply debit this account with the difference 550, you will not clear this account. So you need to first clear this account. Okay, accumulated depreciation. The total, this is total, the sum of the value that is increasing in this account and the other accumulated depreciation as well. So you will first clear this account by saying depreciation, accumulated depreciation How much? 100,000. So this is gone. Revaluation surplus. Revaluation surplus. How much? 100,000. So to make this nil. Okay. Okay. Now this cost, we want to increase it to what? 750. We already have how much? We already have 300. 750 minus 300, 450. So we need to add 450 here. Revaluation surplus. $450. Okay. Now you have carrying value of how much? This is 750. Here you will say carried down balance, you carried forward how much? 750. That was our objective, to bring the carrying value of this asset. Related depreciation is nil. Carrying value, cost of that account or the revalued amount of that asset has been increased to 750. And now we need to book another entry, this revaluation building. For your understanding, building 450 to revaluation surplus. How much? 450. Revaluation surplus account. This is for the year. Of course, you will have opening balance coming for years, but I'm dealing with these entries only. Okay. Credited against accumulated depreciation, how much? 100,000. And against building, 450. And the total balance, credit balance, how much? 550. So that's how we deal with it. 550. Not only that, 450 to increase the cost account, but we also need to clear out the accumulated depreciation account. So the revaluation reserve in fact is more than that. Not only 450, rather this 100,000 also. Total is 550. So that's how we deal with it. But now this will show in other comprehensive income, and this will be the total account. Of course, this will not revaluation reserve. This is accumulated account. It will have opening balance already, whatever you have passed over the years. Okay. Now we'll do another example just on page 152. Before that, I wanted to explain what happens because when you revalue an asset other than land where you charge depreciation, after the revaluation, the depreciation charge increases. Okay, but you haven't realized that gain, so you don't have that in your retained earnings. Bit complicated, but if you understand, that's good. So whenever you charge after this revaluation, if you charge depreciation will be an increased amount because the value of that asset has increased. So what happens to that increased depreciation? This standard allows companies to transfer that from revaluation reserve to retained earnings. Whatever is the excess depreciation, same amount, exactly same amount every year you can transfer from the revaluation reserve to the retained earnings. But that's optional. You cannot, you are not required, or this is not something compulsory. But if you do it, you choose it, then you will have to follow this policy every year. Every year you will transfer that difference in the. This example is also discussing that. That's why I just remembered that. Shortrick owns a retail unit in central Springfield. It bought the property 25 years ago for $100,000, depreciating it over 50 years on a straight line basis. So cost of the asset is 100,000 when it was purchased and being depreciated on 2% straight line. Okay. So how much is the depreciation? 2% per month. Let's say it's 2,000. Okay. So depreciating it over 50 years on straight line basis. At the start of 2016, the company decides to revalue the unit to 800,000. They want to revalue it, revalued at $800,000. Okay. Now I'm just noting the relevant information that to save time. And at the start of 2016, the company decides to revalue the unit to 800,000. The unit has a remaining useful life. Of course, it had 50 years, 20 years, 25 years passed. Now it has 25 years at the date of the revaluation. It's company policy to make the annual transfer of the excess depreciation between revaluation reserve and retained earnings within equity, as I said earlier. Okay. Now, let's first revalue it. Now, how much is the total accumulated depreciation? Accumulated depreciation is simply 200,000 into 20 years. How much? 50. So they have related depreciation. Cost this 100,000. Cost. This was also depreciation. Cost was 100,000 and the accumulated depreciation is 50,000. So net book value is how much? 50,000. They want to revalue it. Let me prepare the accounts as well. What was that actually? Sorry. Property. Say, let's say building. How much? Brought forward is how much? 100,000. And accumulated depreciation till date brought forward. We calculated 50,000. Okay. Now, if you want to revalue it to, we don't need it now, and I need clear space. To revalue it to 800,000. Total surplus, how much? Take the net book value minus 50. You understood? Net book value 100 minus 50, 50,000. So the total gain will be 750. Okay, but we need to clear out this account. So we'll pass that entry at, as I said earlier, evaluation surplus 50,000. Okay, and bring that value to 800. 100 we already have, and revaluation surplus. 700. It will be carried at now 800. This has been zeroed out. Okay, now if they charge depreciation for that year on 25 years, now they have this 800,000 straight line. 800,000 divided by 25. How much is that? $32,000. Now, see, the depreciation charge for the year increased from 2,000. We were charging 2,000 per year before this revaluation, but now it increased from 2,000 to 32,000. So, increase of 30,000 in the depreciation. Here we'll say depreciation for the year 32,000. I'm charging depreciation for understanding, okay? For the year, this will be the depreciation charge. Now, they have, as they said in the example, they have a policy to transfer the excess depreciation from revaluation reserve to retained earnings every year. So, what is that? They will first, we have passed these entries, but that transfer of, you can say, transfer of excess depreciation from revaluation reserve to retained earnings. That an entry is passed like this. Retained earnings to revaluation surplus, revaluation reserve actually. $30,000. Why this entry is being passed? Actually, by depreciating this asset, consuming this asset for 32,000, this 30,000 is been realized out of that gain you booked in reserves, because you have already utilized that cost. Okay, so an estimate of that realized gain is being transferred from revaluation reserve to retained earnings. Guys, an example on page 154 to understand what happens when you dispose of an asset which has revaluation reserve. Tiger Trees owns and runs a golf club. Some years ago, the company purchased land next to the existing course with the intention of creating a smaller 9-hole course. The cost of the land was $260,000. So that's what they have in here, their accounts. Land. Kitna? How much? 260,000. Carried, brought forward. Okay. The cost of the land was 260,000. Over time, the company had the land revalued to 600,000. It has now decided that the building the new course is uneconomical and sold the land for 690. So they had revalued it, okay, basically. So revalued it from 260 to 600,000. How much revaluation gain they are carrying? revaluation surplus or reserve. How much? They increased it from 260 to 600 for 600,000. So what's the balance? 600,000 minus 260 is 340. So that was the revaluation surplus they were carrying. How much? Here they will have brought forward 340. Just wanted to give you how they are getting this 340 they are carrying related to that land in the books, and now they are disposing it off for how much? 690. Okay, so what are the accounting entries? They sold it for 690. So cash 690,000. 690 or 95? 95. Okay. And land we had 600,000. So the gain on disposal is 95. Okay, that gain is coming from that disposal. Okay, but now this is disposed of, this asset which had that carrying value of 600,000 disposed of. Okay, but we still have in the books related revaluation reserve. Revaluation reserve was only related to this property. Now we don't own it anymore. So there is no logic or no question of keeping then in the leaving it, that reserve in the books. We need to clear it off. So simple, like excess depreciation, just transfer it to retained earnings. It will not come to the profit and loss account. Just change in the statement of changes in equity. Retained earnings, sorry, that revaluation reserve debit to retained earnings. $340. So here you will say retained earnings 340. This account is clear. In the retained earnings you will show this. Brought forward whatever, but this is transfer from revaluation reserve. $340. Okay, so that's how we deal with disposal of an asset for which you have revaluation reserve in your books. For concept purposes, this is enough what we have done on non-current assets, but you need a lot of practice on that. Go through examples as many times you can, because you need to have a solid grip on this to get a passing marks from this topic. Thanks a lot for watching this video, and if you are interested in the previous topics or on the same topic in the previous videos, link is in the description. Thanks again. Thanks.